The lesson of 2018 is that the low volatility environment is behind us. And so geopolitics totally matters. And if you look at the markets this week, it matters a lot to both the bond markets and the commodity markets. And now the new worry, and worries are not a bad thing in bull markets, is whether inflation is going to come back as a result of geopolitics. But ultimately, with this kind of earnings strength and the economy that looks set to grow, closer to 3% than 2%, we think that's compelling value for the stock market.
Karyn, obviously, a lot of this is going to be riding on what we hear on these earnings calls, what you hear from companies in terms of their expectations for growth. What do you think we need to be hearing?
Well, I think they need to be looking forward because the bar is going to be set pretty high now that we're seeing a lot of good earnings in 2018. But investors are going to want to see that that's going to be continued and that 2019 is also going to be good in order for them to really get excited about. We have high expectations already, so we don't want disappointment, so we want to see some further earnings growth. But I would agree with Julian, but also add that the tax cuts are really going to kick in. I think 3% is in the bag for 2018, and I don't see that we're going to drop off in growth. I think it's going to get even better as these tax cuts work their way through the economy.
So you're expecting new highs too?
I am. I absolutely am. And I'm not really that worried about inflation. Inflation, I mean, we still have slack in the labor market. The difference between the U6 and the U3 is pretty large. We can get a lot more workers into the employment area. And I think that there's a lot of global forces, technology, and inflation is really not a worry right now. I think it's more of a worry is that the Fed is going to be aggressive, and they seem to be very determined to raise interest rates just so that they have some ammunition if things go badly. And right now, that flattening yield curve is probably the thing that's rattling the most investors.
Sure. I mean, the message yesterday, Bill Dudley, outgoing New York Fed president, basically said, we're on target to get the short-term rates up to 3%. They seem not to be very dependent on what the data comes in like. So what's the bond market's message there? Is that the Fed's going to get to a point where it really snuffs out any threat of inflation, and that's why the curve is so flat, and it's not really a commentary on how growth looks going out, Julian?
Well, you're walking that very fine line when the yield curve is this flat, because traditionally when you get to an inversion or near zero, that signals a recession 12, 24 months away. So for us, it's actually good the last couple of days that you've had as many Fed officials talking about this, because talking about it is good. Because the real problem here is the geopolitical uncertainty is raising the price of oil. It's raising aluminum prices, copper prices, et cetera. And does that feed in on a permanent basis? And that potentially changes their calculus, where they have to stay more aggressive and ultimately end the cycle at some point, which is why how the course of negotiations, whether it's North Korea, Iran, China, Russia, what have you, that's why the next several months are very important.
We've had a lot of people who have come in and said that it's going to be the small caps that really outperform this year. And sure enough, Russell 2000 is only about less than 2% off its all-time highs right now. Is that still a play that you like, Karyn?
Absolutely. The small businesses are really the ones that are the backbone of the U.S. economy. If you take a look over the last 8 years, they've added more jobs than large companies. So these small companies have been burdened by regulations, by taxes. So that, like I said before, the tax cuts are working their way through the economy. If you keep your eye on the small business, that's where the action's going to be. And so therefore, small caps are very attractive, but also emerging markets and international stocks have compelling valuations. So everyone's worried about the large caps, and the large caps are great, but there's a whole nother spectrum of other asset classes out there, and being globally diversified is always a good idea.
If you use the Russell 2000, though, to capture the small cap asset class, it's got a higher percentage of financial stocks than large caps do. I mean, it seems like it's not disengaged from the stuff that's also infecting, like the flat yield curve. So I just wonder, Julian, if you think that's going to be a real rotation, or just it can participate as well with everything else.
Well, for us, the small cap story is the aspect of, with all geopolitics around right now, small cap derives its core revenues from U.S. growth, internally driven growth, and that's really the reason for us that you want to tilt that way.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.